One reason why stocks are particularly unsettled today is because of a worse than expected Chinese PMI number of 48.1. That's an 8-month low. Jason White, what does this mean for emerging market investors?
I think it just means more uncertainty around growth for emerging markets. That's really been the key story for emerging markets over the past 18 months has been the disappointing growth, the somewhat higher inflation, and the weaker currencies. So developed markets have outperformed emerging markets because they've had better expectations on all three of those measures. The question now is what does this mean going forward? If you look at valuations, you do get some valuation support for emerging market equities. They're not as cheap as they were in the early part of 2009 or past crises, certainly, but they don't look particularly expensive. So I think you do get some valuation support here, but we're not at the point where you're pounding the table for emerging markets just yet.
It seems like a lot of the worries about emerging markets with regard to both China slowing and Fed tapering are replacing the worries that we had about Europe, things like Cyprus and Greece going bankrupt. What's your stance on Europe right now?
We definitely have a more positive stance on Europe, and you're absolutely right. If you could turn back the clocks 18 months or 24 months, a lot of folks are talking about, would Europe survive? Would the euro survive? And a lot of those fears have gone away. The tail risks have gone away, or a much smaller probability. So what's happened is expectations in Europe have improved quite a bit. A big catalyst for that has been economics, and things have stopped getting worse. So that trend is a very powerful catalyst for European shares to propel much higher. That's why we've seen the strength in European equities. Really, I think the story now is looking for that earnings growth. A lot of these companies have done a lot on the back end in terms of improving their cost base. They're looking at peak margins and so forth. So to the extent that we have a more conducive economic environment, we see some top line growth, I think that'll flow through to the bottom line in earnings quite attractively. European financials would be a great example of that. Again, 24 months ago, no one wanted to look at European financials. They're in a much better position now, better capital ratios, and are potentially looking at an earnings growth story on a forward-looking basis.
All right, and then finally, Japan. Japanese stocks are down around 10% this year. Has Abenomics stalled out?
I think to a certain extent, Abenomics has stalled out. Now, Abenomics is really the key for Japanese equity, in particular the third arrow. So the first two arrows were basically designed to stimulate the economy, weaken the yen, and that's where we've seen a lot of the action so far. The third arrow really is about labor reforms, wage growth, and so forth. That's going to be much harder to get through. Obviously, there are a lot of competing interests internally within Japan to get that done. But ultimately, it comes down to the inflation part of the equation. So far, inflation's been running 2 to 3% year over year, certainly better than deflation. But a lot of that inflation has come from energy prices. What we'd like to see is that wage growth is contributing more and more to inflation. And why that's key for investors is the domestic economy needs to be stronger. So far, a lot of the gains have come from the export sector. To the extent that we see some inflation, we see some wage growth, it's going to be a consumption story within Japan.
All right. Thanks a lot, Jason White.
Great. Thanks.
And thanks a lot, Jason. And thank you for watching The Street.